Hello everyone. Welcome to today's webinar on the gold outlook. And thanks for joining us. And over the next hour, we are going to dive deep into what's really driving the gold market right now. And we are going to unpack the macro trends, look at some key fundamentals, and finish up with some kind of technical analysis. And whether you are trading gold or just want to have some kind of better understanding on the market, there's something in here for you. So let's jump into the session together. Before we start the session, I would like to notice some of our disclaimer that this presentation is for information purposes only, and any information relating to some investments should not be considered as advice or endorsement. And any point of view is the presenter's own and personal opinion only and does not reflect the views of Exness. So here is how today's session is structured. First, we will look at the macro landscape, what the leading indicators are telling us, and how the markets are holding up, and what's going on with the inflation situation currently. And next, we will shift gears into the fundamentals drivers of gold, like central banks and ETF inflows, and geopolitical risks, and the gold demand trends. And finally, we will finish with the live price analysis session. And by the end of this, you should have a pretty comprehensive view of what's moving the market right now and what might lie ahead. So let's begin the session starting with the macroeconomic parts. Let's kick things off with Conference Board's leading economic index. We call this LEI. And now this is one of those indicators that tries to tell us where the economy is heading to before the market shows up in the headlines. Recently, this LEI data has continued to drop, as you can see from here, which would normally suggest growing economic weakness in the United States. But these early signals can sometimes be misleading. The LEI data tends to react before other indicators do, which means we need to consider the possibility that this kind of downturn might just be some kind of noise. So that said, markets still take this seriously because it's signaling some cautions in the market. Now, here's the interesting twist. The LEI index, LEI data actually here bounced back above the so-called recession threshold in the red line for a bit, which initially gave markets a bit of relief. But then it just stalled right there, and there was no further strength. And the reason is one theory is the rising concerns over the recent tariff policy, particularly with President Trump recently reviving some kind of protectionist rhetoric of themselves. And tariff can impact business sentiment and the global trade, which might be dragging down this kind of expectations. So while we are not seeing a full-blown collapse, the lack of follow-through in this recovery is something to keep an eye on very carefully. And now let's take a look at two more indicators that reinforce this cautious outlook. The first, the leading credit index has turned negative again, which tells us market expects higher rates to stick around longer, and not exactly a vote of confidence for the United States economic growth. And at the same time, the ISM New Order Index has weakened as well. We will go through this in detail in the latter part. And businesses are pulling back on new purchases, uh, likely due to trade tensions and the interest rate uncertainty. And all of this paints a picture of caution that businesses are not planning for a recovery yet. But here is some good news on inflation. United States CPI in February came in lower than the previous month. But here is the thing. Investors are not fully convinced that the inflation story is finished or the inflation story is done. And there's still some kind of fears that inflation could spike again, especially with energy prices moving and supply chains not entirely stable yet. So even with this kind of CPI cooling, the Fed has to stay very careful, and they cannot afford to cut the interest rate too fast if inflation expectations are not anchored. And that's a key point for the gold investors and gold traders, because uncertainty about the interest rate policy by the Fed tends to boost the gold demand. And here's is where things get interesting. Despite the weak signals from some economic indicators, the U.S. labor market is still holding very strong. In March, the non-farm payroll (NFP) number beat the market expectations in a big way, and that's a reminder that recession fears are not playing out just yet. So a strong labor market supports the customer and consumer spending, which can keep overall inflation, very sticky. And again, this puts the Fed in a tricky spot. And when there's uncertainty about what's coming next, that's when gold starts to shine, and that's where the gold traders and gold investors should focus on. And in March 2025, US average hourly earnings rose 3.8% yearly, and that's a slight decrease and slight dip from the previous month, 4%, but it is still very solid number, especially considering about the Fed's goal to tame the inflation risks. And wage growth like this suggests that the labor market still remains tight and workers are still in the positions to command higher pay, which could keep core inflation very sticky. So even as CPI slows down like this, earnings data like this keeps the Fed very cautious, and that's the part of reason why the rate cut path remains so uncertain currently. So for gold trader, this kind of ambiguity in the monetary policy direction usually translates to the steady supports for the gold prices. And let's take a closer look at the labor market from a slightly different angle. And this is the job opening per unemployed person. And we call this number JOLTS data. And as you can see in this chart, this ratio has dropped to its lowest level since September last year and is currently positioned at 1.07 something. And what that means, for every unemployed person, there's just a barely more than one job opening. And that's a very remarkable and noticeable decline from the peak we saw post-COVID when openings were well above 1.5 or here even more than two jobs per person. And this trend tells us like a couple of things. First, the labor market is cooling down. Labor market is softening right now and companies are posting fewer jobs. This is maybe because of some kind of economic uncertainty or some kind of tightening financial conditions. And second one, even though unemployment is still relatively very low, it is becoming harder and difficult for the job seeker to find the right job quickly. So from a gold market perspective, for the gold traders or gold investors, a weaker labor market can nudge the Fed toward keeping the interest rate on hold or even cut the interest rate sooner, especially if this trend worsens. And that's generally supportive for the gold prices, which tends to thrive when the rate expectations shift to dovish. And here's a snapshot of the overall US labor market. And as you can see, it is still holding up relatively well. And the unemployment rate rose slightly to 4.2% in March from 4.1%, but that's still low by historical standards. And meanwhile, the broader U6 unemployment rate, which includes the uh, underemployed workers actually fell to 7.9% from 8%. But here's where it is getting interesting. On the right side here, you can see how different tariff scenarios might affect the US labor market. So if the 2nd of April's announcement by the President Trump leads to retaliation tariff policies from China or Europe or whatever it is, unemployment rate could spike to 4.6% by 2026. And this matters for the gold investors because US labor market's weakness can force the central banks, force the Fed's hand. And if tariffs push up the unemployment rate and hurt the United States economic growth, we may see faster rate cuts by the Fed, and it tends to support the gold prices as well. Let's look at the snapshot for the manufacturing sector as well. In March, the ISM manufacturing PMI dropped to 49 from 50.3, back below the break-even line. Of 50, and it goes to the construction phase. And that means that the sector has slipped back into contraction just 3 months after briefly expanding through. And looking at the details, new orders and production both fell sharply, and employment is also down. And even though inventories ticked up a little bit, it is more a sign of sluggish demand than the strong output. And this kind of data reinforces the broader theme we have been discussing through. The US economy is showing resilience, but also real signs of strain under the surface. And when growth falters, rate expectations soften, and gold tends to benefit from it. Uh, Historically, the Q2 tends to be a consolidation period for the gold prices. So if you look at the 20 years of seasonal data here, gold usually does not break out much in the second quarter, but that doesn't mean the story ends here. And the consolidation can actually build the base for the next rally. And depending on how fundamentals and macro conditions evolve, we could be setting up for a move later in the year. So if you are now currently trading or investing on gold, you should look carefully and you should focus more detail on this 20-year seasonality of the gold. And here's what we are looking at right now. Central banks are back in the game, adding to the gold reserves, and geopolitical tensions are easing a little bit, especially in the Middle East side. And the US economy strength has surprised most of us, as we already previously saw from the US labor market data. So the big wild card is the monetary policy. The Fed holding rates steady could keep the gold price supported, but if the United States macro data turns sharply in either direction, it shows a recovery or it shows a plummet direction, we will need to reassess the gold prices again. So it's all about staying alert and flexible in this kind of uncertainty and this kind of environments. Now, here's something that shifted market sentiment pretty dramatically. Then this is the data for the halt in tariffs. And after President Trump paused the planned tariffs, markets quickly adjusted their expectations around the Fed policy, Fed monetary policy. And just look at the chart, the probability that the Fed will hold the interest rate steady at 425 to 450 basis points during May, uh, FOMC jumped to 84.8%. And that's a big move from just 55.5% a week ago. And this tells us one thing: the markets are starting to believe the Fed will stay patient. And part of that is due to the political backdrop. The less pressure on trade means potentially more breathing room for the Fed. So for gold investor, this kind of stability in the monetary policy expectations tends to provide support of the gold prices. So the more confident the market is that interest rates would not move in the short term, the more attractive gold becomes as a store of value, especially when uncertainty still lingers in the growth, and it still lingers in everywhere in the macroeconomic parts. All right, now that we have covered the macro backdrop, let's shift gears into the second part of the session, and it is we will look through the fundamental things about specifically with the gold prices. And here we will dig into the core drivers that influence gold demand and supply, everything from the uh, central banks reserve to the ETF flows to production costs and regional demand shift, etc. And these are the forces that shape the bigger trends of the gold prices and often tell us where the gold price is heading before the charts do. So if you are a gold investor or trader, please focus on these charts. Let's start by looking at who's been buying the most gold and why that matters to us. And now this is one of the most telling slides, in my opinion, but when it comes to what's really driving the gold prices. In the 2024, the fourth quarter alone, central banks added nearly 333 tons of gold, while investment demand, mostly from funds and institutional buyers, reached almost 344 tons. And if you add this, that's over 675 tons combined. And that's not a coincidence. And these are the two really critical facts, key demand segments that move the market, move the gold prices, especially during uncertain periods. And you will also notice how the surge in buying aligns with the sharp rise in gold prices, and up to $2,663 per ounce by the end of the fourth quarter. And this shows us that when both investors and central banks are active in buying the gold, they create real momentum in the prices and within the real momentum in the market. So in short, gold is not just a hedge right now. It's a strategic asset that you should put on your portfolio. And this uh, big players are already knows about this. And that's the reason why currently and recently gold prices just skyrocketed. And here's a remarkable insight of ETFs. And the ETFs may not be the largest segments in terms of gold's trading volume, but they are definitely one of the most influential factors when it comes to gold price movements. In Q4 of 2024, ETF inflows were just around 18.6 tons here, much smaller compared to physical bars, coins, and the other segments of the gold volume. But despite that, ETF flows remain the pulse of market sentiment. And you know the reason why? And because they reflect the fast money and traders and funds reacting quickly to macro economic changes, inflation data, or the changes of the monetary policy of the Fed, and also with the Fed Chairman Powell's commentary. So even small moves in ETF demand can swing prices remarkably. And that's why we watch them closely, sometimes even more than the physical demand of the gold. And if we see a sudden spike in gold ETF buying, it is often a leading signal for the gold price rally, or at least a shift in momentum. So if you are a gold trader, you should carefully look at this ETF influence of the gold. And one of the more subtle but very powerful trends we have seen is this. Even as global gold holdings have surged higher, the regional proportions have stayed relatively consistent. And North America continues to lead in terms of total gold holdings, followed by Europe and Asia. And what's fascinating is that despite the macro shocks, or the regional crisis and shifting in interest rate cycles, the balance between regions has not changed dramatically. And this signals strong, diversified global interest in gold. And it is not just one region chasing this kind of trend. It is some kind of synchronized belief in gold's role as a long-term store of value. And when this kind of balanced participation is in place, the market becomes much more resilient. And they should think about that the gold is the most attractive values and the things that you should put on your portfolio. And here is a more short-term view, and it is pretty interesting and pretty revealing. And over the past several months, we have seen a remarkable pickup in gold demand from North America, which is, we can say, the United States and the Canada. And in particular, these two countries have been facing heightened uncertainty right now, from monetary policy shift to political developments ahead of the US election cycle. As you already might know, the Trump has possessed some kind of hard tariff on the Canada side. And what's interesting is how uh, clearly this demand has picked up when even while other regions remained relatively stable. And that tells us investors are actively seeking for the safe haven right now. And gold is a top choice when the economic outlook gets cloudy like this. And you will also see how this rise in demand has coincided with gold pushing above the $3,000 threshold level. And that's not a coincidence. And this kind of demand often drives sharp uh, the price reactions of the gold. And now this is about as global as it gets. And the 2025 first quarter, every major region added to their gold holdings, with the total surpassing 226 tons. And North America led the charge with nearly 134 tons, followed by Europe around 55, and Asia not far between at over 34. And even regions with traditionally lower volume like Latin America contributed, reflecting how widespread the uncertainty is right now. When everyone from New York to New Delhi in India is buying gold, that's a clear vote of confidence in its role as a safe haven asset. And this kind of synchronized buying pressure is what often sustains the gold rally, and this is the main factors that affect the recent gold rally. And let's zoom in on some of the key players in the gold market. And this is the central banks. In Q4 2024, several countries made a bold movement to increase their gold reserves. Poland led the way with nearly 29 tons at it, followed by the India with uh, 22.5 tons, and China with over 15 tons. And these are not the marginal players, and these are influential economies making a strategic shift into gold. And on the other side, countries like Singapore and Kazakhstan reduced their gold positions slightly, but overall, the quarter ended with a net inflow of gold over 65 tons into central banks' vaults. And these continued accumulations shows us that for many governments, gold is still viewed as a reliable hedge, especially in an increasingly fragmented geopolitical and the monetary environments. Let's now talk about the supply side, specifically the cost of producing gold. As of third quarter in 2024, the all-in sustaining cost we called AISC has climbed to about $1,435 per troy ounce. And as you can see in the chart, this isn't just a recent spike here, as you can see from here. And it's been a steady climb over the past few years, driven by the inflation, higher energy costs, and the tighter labor market. And why does this matter? Because rising production costs creates a natural price floor. And if gold prices drop too far below the cost of production, miners scale back, and that puts upward pressure on the gold prices. So while investor demands gets a lot of attention, we cannot ignore the structural trends on the supply side as well. And it's quite a quiet but powerful support for the gold prices. So if you are interested in seeing the gold prices and analyzing it, please pay attention to this AISC data as well. And let's shift to future markets now, specifically COMEX open interest, which is a great barometer for investor participation. As of early April 2025, the total notional open interest rate in gold futures rose nearly $180 billion, with COMEX alone accounting for over $140 billion. And that's a strong signal that traders are actively positioning the goal in their portfolio. And why did this matter? Because open interest tends to rise when there's conviction in trend, either bullish or bearish. And given that prices have been trending higher alongside this OI increase, the implication is pretty clear. Institutional players are leaning longing the gold. And this confirms that gold's recent price strength is not just about short-term headlines. It is backed by growing capital interest in the derivative markets in gold as well. Okay, so here's something worth watching closely. And despite the gold strong rally, net long positions by investment managers have started to decline. And as of 1st April, we saw a reduction in speculative long positions in COMEX. And that does not necessarily mean a trend reversal, but it can signal some kind of caution in current gold prices. When prices rise too fast, profit taking is very natural, and sometimes traders or investors in gold just want to lock in all of their gains. And this softening in positioning can temporarily cap the upside for the gold prices. But if broader demand, like from central banks or ETF inflows, remains strong, this dip in net longs could just be a short-term breather before the next rally. So in short, the fundamentals still look solid, but sentiment might be pausing for the gold traders. Okay, so this is a last thing. Let's take a little bit of more analytical look at the gold's return through the GRAM model, GRAM model, and that's the gold return attribution model. And what this model does is break down gold's monthly return into various contributing factors. And here's the key takeaway: interest rates, or more precisely, we can say this as opportunity costs, have consistently been the only negative drivers of the gold's return. And when interest rates are high, holding a non-yielding asset like gold becomes more expensive. So even if other drivers are bullish, like inflation or geopolitical risks and geopolitical tensions or currency weakness, interest rates can hold the gold price and the demand back. So this is why any dovish shift from the Fed can act as a major tailwind for gold, and it takes away that one major drag on the gold performance. So if you are currently trading on gold, you should very focus and see how the Fed's movements are. Okay, so this is all from my side, and from now on, will take all of you to the technical analysis based on what we have learned so far. Okay, thank you.
Thank you, Enki. Right, let me just share my screen. So for today, we will be covering mainly on gold. We will also take a look at just across the different time frames how gold it's like. Right, and at the same time, if you guys have any questions or any charts that you want us to take a look at, right, just feel free to put it in the chat. Okay, so just let me share my terminal. Right, so let's take a look at gold from the higher time frames first. So before I do a technical analysis on gold, right, I would also like to introduce this concept. So this concept, it's basically called it's an imbalance in the market, right? So it's called fair value gap. And how it works is that basically it measures 3 consecutive candles, right? So take a look at the same example, let's say here, this 3 candles. And you can see that when there's a very strong move towards the upside, for example, right? What happens is that it creates a gap in between the first and third candle. So over here, right, this is the first candle, for example. If you're to take a look at this as candle 1, candle 2, as well as candle 3, you can see that when there is a very strong bullish momentum to the upside, what this creates is that it creates a gap in between, right? So between the first candle and the third candle. Now, how do we determine whether there is a gap or not, right? It's just by looking at the wicks of the candle. So if I were to zoom in, you can see that what happens here is that, just remove this. So what happens here is that the wicks of the third candle, which is this candle, does not overlap with the first candle. So what it creates is that it creates an imbalance, right? So there is very strong buyers or move to the upside, and there's a lack of sellers, right? So in cases like this, right, these areas can serve as potential support in an uptrend, and then vice versa in the downtrend, it could serve as a potential resistance. Now, why this fair value gaps is important, it's because it provides clues as to where prices could be heading. Right, so 2 things we need to consider. First is that we need to take a look at, of course, key support resistance levels that prices might be pushing towards. And then beyond these levels, it lies the idea of liquidity zones, right? So beyond a high, for example, beyond this high, there would be buy side liquidity here. Right, so for example, beyond this high, take a look at key resistance levels, this area. What happens is that you can see that generally if you've identified a strong resistance and support levels, we can see that price would move slightly higher beyond that level before a move to the downside, right? So this is also what's considered liquidity being taken, right? Or a liquidity sweep. So idea behind this is that when we see a strong support and resistance levels, right, usually coming into these levels, it will entice sellers, for example, people who are bearish to enter sells, putting the stop losses just slightly above the level, right? That's one. Or breakout traders looking for price to break above this, have their buy stops triggered before price continues to the upside. So what this creates, right, both scenarios that I've just mentioned, it creates an area of liquidity or buy side liquidity pool. Basically, above this key resistance levels, the buy orders lying just slightly above the zones, right? So, or what we call buy side liquidity. So in line with that, you can see that what happens is that even if I were to just move slightly back to take a look at historical data, you can see that beyond every move, right, if price were to move to the upside, we will see a sweep of these lows, right? So equal lows or lower lows before price continues to the upside. Okay, so you can see the same for gold price movement, right? Even on the lower time frames. So with that in mind, right, let's take a look at gold starting from the higher time frames. So if you take a look at it on the weekly time frame first, right? So I'm currently on the weekly time frame. You can see what we have here, right? So gold on the weekly, it's still on a strong bullish uptrend. Just looking at the price movements, you can see higher lows and higher highs that were being formed, this region here. It is also interesting because it's holding within this ascending channel. So if we take a look at this ascending channel, but to extend this channel, you can see that gold prices are potentially testing the upper bound of this channel, but there are no signs of reversal at the moment, right? So for any kind of reversal, we always want to go to the lower time frames and ensure that there is this shift in market structure, lower lows, lower highs that were being played out, right? And then that gives us an indication that price could see that retracement. But if we were to move on to the lower time frames later, you can see that it hasn't happened yet, right? So on the weekly, we are still in a bullish market structure. Now, if you take a look at the most recent price movements, right, if I to zoom in slightly, you can see that gold has reacted off this bullish fair value gap. So recall I talked about fair value gap being an area where the wicks of the first and third candle doesn't overlap, right? And we notice this here, right, which is this region here. You can see that the wicks of the first candle as well as the wicks of the third candle. So these are the 3 consecutive candles that we have. This region here, and you can see that the wicks of the first candle, which is this high, as well as the wicks of the third candle, which is this low, it doesn't overlap. It created a gap, right? Price pushed up, tested the upper bound of that ascending channel before it pushes back down into this fair value gap, the one that I've marked out in pink, this region over here, right? And we're seeing that bounce again. So this region serves as a potential support on the weekly. So you can see that on the weekly time frame, price actually pushed into this bullish fair value gap before it continues the move to the upside. Now, if we were to just analyze this move that we have over here and break down this move to the upside, you can see that if we were to move down to the daily time frame, right? So on the daily, we don't see much difference from the price action on the weekly. You just saw the strong move to the downside. And then after that, what happens is that price also swept a low. So this was the low. You can see that price sweeps slightly to the downside before it continues higher. It also pushes into that weekly fair value gap that we mentioned, this region over here. Now, if we were to move down to even lower time frames on the 4-hour time frame, you can see that following the move to the downside, let me just switch off the economic calendar for a while, right? So you can see that what we had here, right, following a sweep of this support level, so you can see the price pushed to the downside, swept the support level, and you can see consolidation within this region. So following a sweep of the low, you can see that price consolidated. It was also testing that weekly fair value gap that we talked about, right? And we're just seeing that move to the upside again. So at this area over here, you can see that what happens is that when this bullish momentum persists on the lower time frames, you can see this bullish fair value gaps holding, right? So not so much on the 4 hours. In fact, price did not actually pull back to test any 4 hours fair value gap. But what happens, it's if you move down to the 1 hour, for example, you can see that prices are still in that bullish market structure. It's forming higher lows and higher highs, right? And what's interesting to note is that it's currently holding above this H1 fair value gap. You can see this H1 fair value gap over here. Again, this is a gap that was formed because of the strong move to the upside, creating an area of imbalance, right? Price delivered that sell side inefficiency back into this gap before it continues higher. So at this point in time, what we have on a 1 hour is that prices are sitting on this potential support, right? I say potential support because we have to go to the lower time frames and see how price react here. But at least on a 1 hour time frame, you can see that this is the first potential support that we have. We have equal highs that were being formed here. So let me just remove this ascending channel, given that it's on a higher time frame. Right, if you take a look at it on the 1 hour, so what we have is that we have equal highs here. Right, so equal highs, you can see this candle. So let me just put this. Right, so this is the equal highs that I mentioned. You can see that this was an area that price spiked twice. We have a region over here that price reacted off once, and then over here, price have yet to reach this high, right? It's slightly short of it where we saw that retracement and then push back into the H1 demand zone. So for me, right, this region, it's a potential resistance that we could see a spike up into this region over here. And if you were to zoom in to what we have on the 1 hour, you can see that this sits also aligned with the H1 fair value gap, right? Again, the fair value gap comes in here, and it's an area that has been respected before. Why would I say that this is a fair value gap? Because if you zoom in onto the H1, you can see that there is this gap that was being formed from these 3 consecutive candles. This is the first candle. You can see that this is the wick of that candle, and then this is the wick of the third candle. So they did not overlap, thereby creating that gap. And if I were to extend the gap to the right, you can see that price has actually respected the gap once over here and then again over here before we saw a strong move to the downside. So this region could serve as a potential resistance on the 1 hour time frame, this area over here. Right, so what I want to do right now is I want to zoom into this region, right, on the lower time frames, be it the 15 minutes, right? So depending on the duration of the trade that you're holding, right? So for example, if on the 15 minutes, then what I want to do is that I want to focus on this move to the upside. I want to see that there are prices are respecting this bullish fair value gap pushing into this high, right? So if I were to move down to the 1 hour, right, I won't go to the 15 minutes because it can be choppy, but if you were to take a look at it on the lower time frames, it can be 15 minutes, 5 minutes, you can see that if price starts respecting this bullish fair value gap on the lower time frames, then it's an indication that price could target this high, this region over here. And then beyond that, right, lying just slightly above this, it's the H1 fair value gap. So that's my view on gold, right? So I think that as long as price holds above this, we could still see that bullish momentum persists. There's still no indications of any kind of reversal at the moment. You can see that it's holding, for one, it's holding above that support zone. If you take a look at EMAs, right? So EMAs are basically trend following indicators. So this also means that during trend following indicators, they could serve as potential support. As what we saw, EMA 21, you can see that price actually held above this EMA 21. It came near it multiple times before we saw that rebound, right? And also the bullish crossover on the EMAs would suggest that bullish momentum that is still following through with. But one thing to note is that EMAs by themselves, right, even though they are trend following indicators, which means that they are useful when markets are trending strongly in direction, they can give a lot of false signals when price chops around, right? Take a look at this example here. You can see that when price starts chopping around, that's when EMAs, right? If you're using EMAs as a bullish or bearish signal, then this is when it can give a lot of false fake outs. So that's one thing to keep in mind, right? So on the EMAs itself is still bullish, right? But more importantly, if I were to take a look at key levels and how prices are interacting with these zones, right? At the moment, it's still holding above the support level. There is a potential high over here, right? The other thing that we want to take note of is what we call the different sessions that we have, right? So generally in FX trading, it's split into 4 sessions: Asian, London, New York AM session, New York PM session, right? So at this area, you can see that this high also coincides with the Asia's high. Right, so if we do see bullish momentum follow through with this, right, price could push up, test this move, and sweep this high to the upside, right? So before pushing into that H1 fair value gap. And so the other thing to note is that will we see a potential reversal below this area, right? So a few things can happen, right? From one, we could see price just chopped around here before we saw a strong move to the downside, seeing this support level break altogether. The second one is that we could see a sweep of this high, right? Price could continue to the upside. So in this case, we want to ensure that when price is interacting with this zone, on the lower time frame, it's showing me a very clear shift in market structure before taking any shots, right? If not, this bullish momentum, at least on a 1 hour time frame, you can see that it's still holding and it still persists, right? Even though if to just break down this region, you can see that on the H1, prices are holding above this. And if you take a look at earlier fair value gaps, you can see this region over here. Prices are still holding above that bullish fair value gap here as well. You can see if I to just narrow it further, you can see what happened. Price actually pushed into this region. So if I to zoom in, right, so what we have over here is that price pushed, we saw a strong break to the upside, and then the bullish candle, right, leaving an area of imbalance. Price filled that gap before it continues to that upside, right? So these areas, if combined with the higher time frame narratives, right, this fair value gap can be a very interesting key level that we can use, right, to determine the general direction of the market. Okay, so that's go for me, right? If you guys have any questions or if you guys have any charts that you want us to take a look at as well, right, please feel free to put them in the questions chat. Okay, the other one that I would like to highlight, it's actually on pound dollar, right? So pound dollar, it's also sitting on a key level right now. So another interesting one to note. So let me just break it down, right? So on pound dollar, we have on the higher time frames first. So let's take a look at the higher time frames. Okay, so what we have on pound dollar, it's that you can see on the daily time frame, right, prices are testing this ascending trend line. Let me just again hide the economic calendar. So we have price, right? So we have price on the daily time frame. It pulled back into this ascending trend line, which is over also the previous area of consolidation. You can see this area of consolidation over here before we saw a strong move to the upside, and price pushed back into this zone, right? Along with that, we also have on the daily bullish fair value gap that prices are holding within. You can see this region over here. And so we have a support level on the daily, we have that ascending trend line, we have this bullish fair value gap, the prices are holding. It was also an area of consolidation previously. If you take a look at it on the 4 hours time frame, moving down to the 4 hours, what we have here on the 4 hours, it's that we have this seemingly tug of war that we're seeing right here, right? Because even though we saw that rebound to the upside on the 4 hours time frame, what is also interesting to note is that this whole rebound that we have, right? If you have to break down that price action on the lower time frames, you can again see the same pattern following through, right? We have bullish fair value gap that prices are respecting before it moves to the upside. And this bullish fair value gap really comes in forms of higher lows and higher highs, and price just pushing back into these gaps, right? One of them, it's this one, which held as a support. You can see this level. I'll just put this in a different color so that it's easier for us to see, right? In blue, you can see that again, the gap was formed because of how these 3 candles react. Over here, right, you can see what happened, right? So basically, this is the first candle, this is the third candle. Price pushed up, we saw it created a gap, filled the gap before it continues to the upside. And accompanied with that, we also have higher lows and higher highs that were being formed, right? In forms of higher swings. If you take a look at it in close in a line chart, you can see that as well, right? So one thing to note is that if you're not familiar with candlestick patterns, you can take a look at just general line chart, just see the highs and lows, right? And see the turning points. If prices are continuing higher highs, higher lows, then this could suggest an uptrend. If prices are forming a lower lows and lower highs, then that could suggest a downtrend. If we're seeing price just chop around with no clear market structure, then that could suggest a sideways trend, right? So that's how I use that to help in my analysis. So at this point in time, what we have, oops, let me just change that. Right, so what we have over here on the 4 hours time frame is that we see that price actually swept equal highs here. So if I were to move down to the 1 hour time frame, you can see this clearer as well. Right, so let me just move this. So price pushed back into or pushed up into this resistance level that we have, this region over here. You can see that it's equal highs that were being formed, this region. Right, you can see the equal highs that were being formed. So this is at about the 1.2920, 1.2930 zone, this region, right? And the highs were being formed because of this move here. here, and then over here. If you want to make it more obvious, you can also switch it to line chart. To switch it to line chart, you can see the significant high before we saw a strong move to the downside. Prices are currently testing this zone again, right? And also accompanied with that, we also have a fair value gap. So let me just change it back into a candlesticks. You can see that along with that, right, what we have over here is that we have this big gap that price formed. This region here, if you see it on a 4 hours time frame, it will be slightly clearer. Right, so this area. So on the 4 hours time frame, we can see very clearly there is a gap that's been created here between that first candle and third candle, right? And that 3 candles that we have, it's basically these 3 candles. So it created that gap. Prices are testing that resistance region right now. But again, if we were to see any kind of reversal below these levels, we want to ensure that that's accompanied with a shift in market structure on your lower time frames, right? As of where we are right now, there isn't anything like that. If you take a look at it on the lower time frames, be it on a 1 hour or 30 minutes, you can see that price swept the last high, right? But there's no indication of that shift in market structure for further move to the downside. So right now I'm just monitoring this region, right? Just trying to see how price react off this zone, and if New York AM session comes in, if we do see any kind of reversal here, right? So at this point in time, if price does push, right, if we do see that shift in structure on the lower time frames, what I want to look for in the next one, or rather the next support level, it's where price could potentially retrace to, right? So if we do see that retracement, where could price retrace to? For that, we need to take a look at it again on the 4 hours to try and identify if there are any key support levels, right? The most immediate key support level that we have, sorry for that, the most immediate key support level that we have on this zone, you can see is that this high that we had, it was the previous resistance level before price broke to the upside. And this area also coincide with this move here, right? So you can take a look at it in terms of support and resistance levels, right? This region over here. If you take a look at it in a line chart, you can see that this was also that last high before we see a strong move to the upside. And so this is a potential area of retracement that price could pull back into. Let me just go back to this. Right, so this is a potential region. But as I've mentioned, even if you're on the 30 minutes or even the lower time frames, we're not seeing that reversal at the moment, right? We have this potential reaction, but beyond that, right, you want to again always see if there is any kind of shift in market structure. Now, if you take a look at 15 minutes, right, if I to break down that same price action, you can see on the 15 minutes, right, we have the last support level, which is this area here. Again, it's a fair value gap. Price broke to the upside, tested, and then it pushed back down into this zone, pushed back up into this resistance area. Right. So on the 15 minutes time frame, you still have that support level holding, right? Price could test this zone. If we want to see any kind of reaction, we want to see this zone break, right? And then price just forming lower lows and lower highs to pull back into the next potential support region. Okay, so I hope that this has been clear so far, right? In terms of the lows, you always want to target the next support level, because beyond that support levels, there would be potential liquidity region or sell side liquidity, right, as potential targets. And so that's on the 15 minutes time frame. So this currently where we are right now. Again, on the 15 minutes, you can see that the bullish momentum still holds. We could push into this region. It could be a potential resistance, depending on how price action react, right? But if not, price could just go right through it as well. So if we do see any kind of reversal, we want to be accompanied by lower swings. We want to see that break in market structure on the lower time frames. We want to see this bearish order flow kicking in, basically, right? And if that happens, then this could indicate that price could push into this swing low, which is also that area which price tested as a resistance previously and a support. It's also this low over here. You can see that this happened during the Asian session, right? So this region over here, between 6 p.m. to 2:30 a.m., right? So this area, so this is the Asia, this is equal lows that's formed during the Asian session. So if price does pull back, right, then this could be a potential target. Okay, so yep, so those are the two setups that I have right now. The next one that we can take a look at would be on dollar index, right? So given how bearish price has been, we have a question on Bitcoin. So let's take a look at Bitcoin. So again, we take a look at Bitcoin on the higher time frames first. Right, so Bitcoin itself has been a risk asset, so you can see that Bitcoin has been under pressure recently as well, in line with that whole equity sell-off that we're seeing, especially when fears kicked in around the tariffs. So yeah, let's take a look at it on the higher time frames, but just bear in mind that, you know, Bitcoin, it can also react, or it can be under pressure as well when risk aversion kicks in. Right, so if we're on the monthly time frame first, you're on the monthly, you can see on the monthly here, right? It's still in that bullish market structure. We have on the monthly again, price testing this zone, right? This is that monthly fair value gap that we have. You can see price is currently testing this region. Now, at this point in time, right, whether price will rip right through this area or it could just rebound from here depends a lot on the lower time frames. So this is something to keep in mind, right? Interesting to note that price also swept the previous month's low. You can see this region over here. Right, and we also want to bear in mind that the previous fund high could be a potential short-term target. So I'm just going to put resistance area over here, right? This region as a potential area to watch, especially when price push into this region. Now, if you're on the weekly time frame, you can see that price chopped around. We're seeing a lot of moves, right, or consolidation within that monthly support level. Right, so nothing much on the weekly. We're seeing the sweep of previous week's low as well, but choppy price movement, I would say. If you move down to the daily time frame, you can see, excuse me, on the daily time frame, what we have here is that you can see price swept previous lows, this region over here, right? We saw a sweep of the previous low before that rebound to the upside. If you move down or if you trace that whole move to the downside, you can see that on the 4 hours time frame, the last region that we had, which price reacted to as a resistance, it's actually this area here. So let me just put this in blue. You can see this area that I've highlighted in blue, right? So this is that 4 hours resistance that we had. You can see that price pushed up into that 4 hours fair value gap. If I were to zoom in, you can see this area, right? And before we saw that retreat to the downside. So right now where we are, at least on the daily time frame, right, there isn't any indication of a reversal yet. We are sitting potentially on the monthly, a support level, but if we were to see any move to the upside, I want to see that bullish order flow kick in, right? So I want to see basically price on your lower time frame form higher lows, higher highs, which we are not currently seeing at the moment. Right? If you move down to the 4 hours time frame, now this is very interesting because what we have, it's potentially a double bottom in that higher time frames demand zone, right? I say a double bottom because of how price reacted here. You can see that this for a double bottom to be valid, right? We need price to break above that neckline, which we saw as a potential neckline, right? So this, it's potentially a double bottom, right? And it's more significant because it's sitting on that monthly demand zone. But one thing to note with this is that if you're to take a look at the 4 hours time frame, right? So I talked about bullish order flow, right? I talked about higher lows and higher highs, which we saw over here, right? So on the 4 hours time frame, you can see that the most immediate demand zone that price could potentially hold above would be this region, which is that 4 hours gap that we have, right? And if I to narrow it down further, if I move down to the 1 hour time frame, you can see on the 1 hour time frame, the most initial gap really comes in here. So price respected that zone. You can see this area, the blue lines where price pushed up, tested the zone before we saw that strong move to the upside. It's worth noting that the last or the most recent high has been swept, this area here. So currently prices are testing that demand zone again. So if we do see that pullback into this area, I want to again observe that same shift in structure. Lower lows and lower highs pushing into this zone. I want to see price breaking above that last high, right? Before it indicates that this demand zone is being respected, then you could target the next high over here, which is that 4 hours zone over here. Or even if you're to move to the daily, right, the previous day's high, that's the most immediate resistance. So the previous day's high would come in here. You can see this region over here. So that's a potential resistance, right? Even though the it's relatively near the previous day's high as well as the previous week's high. So this region, you can see that this is the previous week's high. But to just zoom in slightly, you can see, there we go. Right, so the previous week's high is basically just taking the highs of the previous week's candle. So Yep, so those are the two potential resistance. So if we do see that bullish or higher lows, higher highs coming through, right, after holding above that demand zone, then we want to ensure that if we see that, right, then price could push into that previous daily high, which is this area that we've highlighted, and then beyond that, right, if we do see a further move to the upside, then previous weekly high as target. I would say in terms of where prices are right now, it's still very choppy, right? We want to see very clear bullish structure following through, right? We want to see price respecting that demand zones. At the moment, there's only one here, right? So this area has not been confirmed as a demand, right? So price could push right through this area, potentially retest this zone again, which is why I mentioned that every time we do see a move to the downside, it'll be accompanied by lower lows and lower highs. So if we do see that shift in structure, if price pushes into this zone, for example, and we see that shift in structure happens, then we want to see this bullish market structure kick in before it indicates that it has the potential to move high. Okay, so I hope that answers your question with regards to Bitcoin, right? So yep, so that's what we have for today, right? Thanks everyone for joining us. So as always, we are doing this on a bi-weekly basis. So you can sign up for the sessions either through your account managers, right? Or you can also check out the recordings on YouTube. Okay, so with that, we've come to the end of the session. Thanks everyone. Have a great trading week ahead, and we'll catch you guys again soon. But just one more thing, right? Before I forget, right? We have a survey session. We have a survey at the end of the session. So please help us to fill in the survey form, right? In terms of what you like or dislike about the session, what you look forward to, so that we can better tailor it to your needs. So yep, thanks everyone. Have a great day, and we'll catch you guys again.